Hi, everyone. Um, we're just waiting one more minute for everyone to sign up. There's 900 people who've registered to see this webinar, so I'd be grateful if you could wait just one more minute. Thank you.
I'm gonna go up.
Hi, everyone. So I presume you can hear me, as I got a few questions already popping up on the webinar platform. So thank you very much. Just to confirm, the recording and the presentations will be made available afterwards. But we do encourage you to listen in live, as you will have the opportunity to participate in the Q&A. I can still see that there's a few more people just signing up, so I'm going to give them just 30 seconds before we will begin. Brilliant, everyone. Well, thank you very much for joining us. It's 11 a.m. in the UK, 3 p.m. in Dubai. We have 900 people signed in live to join us today for this webinar, Opportunities in MENA for Captive Solar. And I would like to thank in advance Jeremy, Apan, and Debbie for their participation. While people are signing up still, I would like to quickly show you I'd like to quickly tell you that this webinar is in conjunction with the MENA New Energy Summit taking place in Dubai on the 24th to the 25th of April. This conference has now run for 10 years, and it really is home for the solar and wind industry. But this year is particularly exciting as we'll be focusing on energy storage and also captive solar. So this is a new area for us at the conference. And for this reason, we're running this webinar to showcase the experience of some of our speakers on this subject. This is the format of the webinar. As you can see, we have 3 speakers who will join us. We will have Synergy Consulting, who will deal with the financial related issues. We'll have DLA Piper, who will tackle the legal and regulatory requirements. And then we'll have Yellow Door Energy, who will give us share us their experiences as a project developer. As you know, you'll also have the opportunity to submit questions. I can see many of you have. So as we have quite a few people tuned in, if you would like me to direct your questions to a certain speaker, then please just mention that person's name. And generally speaking, it's not a fixed rule. If you have a financial related question, best send it to Synergy Consulting, legal questions, DLA Piper, and development questions to Yellow Door Energy. So I've noticed that actually there's quite a broad range of people who have signed up to this webinar, ranging from developers, EPCs, financiers, legal, insurance. And so I thought I would just begin by making sure everybody knows what captive solar is. And in my opinion, it's as follows. It can be either on-site applications such as rooftops or carports. It can also be off-site applications, ground-mounted solar farms. So it's really those two categories. It's not one or the other. And I think the important thing to know is it can be part of the central grid or it could be its own distributed network. So this webinar will really focus on the business case for captive solar in the Middle East and North Africa region. And there's quite simply a lot of benefits to captive solar. For me, I think the most obvious one is the first one. It's just more energy efficient. You get electricity generated and transported to the consumer much more efficiently because there's fewer transmission systems to rely on. So less cables, less voltage loss. It's a no-brainer. So how can we make this work? And now I will put us through to Apan, our first speaker of the day. I'll be connecting to his screen now. Apan, over to you. So we'll be just.
Yeah. Thank you so much, Paul. Thank you for the opportunity here. See, you are right. I mean, we are very excited about the captive solar opportunity that's kind of coming up in the whole of GCC, really. In fact, we ourselves are kind of working on 5 different large opportunities, again, in the captive solar sector in the region. So definitely an exciting sector for us, which we are kind of seeing grow as well, quite significantly. Among the points, I mean, I think you already highlighted most of these, but just one additional point in relation to captive solar that I would like to highlight on is basically on the tariff certainty. Now, with the changes that we are seeing in the economic climate within the region, with the reduction in subsidies that we are seeing in the region, we are seeing that taking that into account, there's a lot of uncertainty on the tariff that is going to kind of come up in the region. For example, within Saudi, we saw a substantial increase in tariff very recently in 2018 itself. Oman saw an increase or a change in tariff structure itself. It kind of changed to a cost-reflective tariff structure last year, which in effect had some increase in the tariff for the commercial industrial consumers. So with all of that in mind, having that tariff certainty has kind of become an important parameter as well for many of these developers, which again drives the commercials and the economics behind setting up such captive solar projects. And that's one of the key drivers that we are seeing, which is kind of impacting many of these industries, many of these commercial land bank owners to kind of look at this option seriously. Within the recent history, we saw KSA, Princess Noura University within KSA, as one of the latest projects, which had captive solar opportunity as captive solar project as part of its development. We had others as well in KSA across. I mean, the list that we have obviously is not exhaustive in any manner over here. But just one opportunity that I would like to highlight out in this one that came about was for the Dubai DP World project. Now, this was interesting because this was among the few opportunities which was done on a bid basis with an OPEX model. I mean, I'll come to the structure, the model part shortly. But this was an opportunity which was bid out. It was done on an OPEX model, and it had various rooftop warehouses as well as commercial building rooftops as well as car parks, which are all kind of combined together in this project. So it was quite an interesting project, and it's under development right now. Now, what all of this also points towards is that, for example, for this same DP World project, uh, the project saw more than 50 bids kind of come in for the transaction, basically indicating that there is a lot of interest for such captive solar opportunities that are coming up, the size for which is now increasing in the region. And compared to the utility scale opportunities, which are also kind of coming up, which are comparatively fewer and further in between. Captive solar, we see that development going on very aggressively in the region right now. In fact, within KSA itself, we know that there's almost more than 300 megawatts of development that's currently active, and that's just the ones that we know. I mean, there's a lot of activity that also happens under the radar in relation to captive solar projects. Now, as you mentioned, I mean, there's the on-grid and the off-grid structures, but on the on-grid side, just a couple of points to highlight there would be that many a times this on-grid structure is really successful when there is that direct government involvement, when there is that direct government support, which supports and encourages local site generation and consumption. And typically, that's the kind of structure that we are seeing most commonly being utilized, where these regulations effectively support a self-generation and consumption rather than having a direct sale to the grid supply. So it's kind of on a net metering basis, which then kind of forms an important part of such on-grid structures. For off-grid, that's also an exciting place right now, really, because we are seeing such kind of projects kind of come up, say, for example, in Oman as well. But some of the key parameters to kind of take into consideration when you're looking at off-grid structures, and off-grid can be effectively connected to the grid as well. It's just that you're not supplying back to the grid, so you don't have a bidirectional meter which kind of supports that. So in that case, I think one of the important parameters that we have seen consumers specifically consider for their feasibility study is really the hourly load consumption and annual profile of that, because that kind of is kind of a key parameter which helps them structure what's the size of the project that they want to install, what kind of curtailment losses, if at all they're willing to take that, what level of curtailment losses would be most economically feasible, and how to kind of integrate that supply, that captive solar supply with the existing supply that's in place. And these are kind of the top considerations in terms of their feasibility that they kind of take into account in these cases. Now, with that structure or structure in place, I mean, the key installation models that you've seen are kind of common across. I mean, you have rooftop, you have carport, and you have ground-mounted structures, which are effectively considered in all of these cases. Now, obviously, ground-mounted kind of becomes the most economical option of the lot, specifically considering that the structures required for that, all the EPC cost, the O&M cost, all of that is lower as compared to, say, a carport, which will probably have higher EPC cost because of the structures, and rooftop as well, which is then effectively getting installed on the roof, so has the consequent impact on costs. But with that in mind, I think one aspect that is important to consider during ground-mounted, while considering ground-mounted structures, is also the opportunity cost of the underlying land assets that are being utilized for such structures. So typically, and consequently, we have seen that these kind of structures are more utilized where land is more freely available without much additional cost, and that's where we see much larger size projects and with entities which have a decent amount of land bank at their disposal to utilize. Now, with those structures in place, I mean, the first question that really comes from the off-takers is really between a capex model versus an opex model. Now, these are kind of the two very basic structures that we see in place being utilized by various off-takers or customers. The key difference being that under a capex model, I mean, they are definitely easier to implement. It's comparatively cheaper for the customer on a net basis. But in that case, the customer is effectively taking most of the risk related to the asset, related to its operation on themselves, and including related to financing. Whereas under an OPEX model, you effectively have the customer paying a standard tariff going forward. Now, that tariff can be a fixed tariff, which is, say, indexed in some manner, or you can have a discount kind of methodology, in which case the operator, the project developer, effectively gives a slight discount over the existing tariff and operates the project for you. In both these cases, the level of risk now remaining with the customer is limited. But nonetheless, I mean, there are certain risks that the customer still carries, which are more linked in cases of, say, termination and so on and so forth. Now, there are several other structures as well, but you see that most of them are effectively derivatives of these basic structures itself. One of the most common ones being where, for example, the customer is not the owner of the land itself. So in that case, you would effectively then also give an access right, which is kind of signed with the owner of the land bank also, and kind of have that structure in place. But again, as I said, mostly derivatives of these these two structures. So with that, I mean, coming to the off-taker back, so whenever we are in discussions with off-takers, and that's kind of an initial query from their side as to which structure to utilize, I think these are kind of our four basic questions that we put across to them. Whether or not you're ready to put in the financing upfront, whether or not you have the availability of resources to take care to operate that plant, whether you really want to do it considering your core business itself, and largely, but definitely not the last, what's the project size that you're looking at? Because with smaller sizes, then it's kind of better to let it off on a third party completely, rather than really take the complete process through and through. So typically for an IPP kind of structure, an OPEX kind of structure, you would see, which is specifically done on a bid basis, you'll see the size of the projects are significantly larger. I'll come to the last slide here because, I mean, the previous slide is really a summary of this itself. And so what this table basically indicates, it basically showcases the current tariff levels that we see in the region for different regions. We have for Dubai, Abu Dhabi, and KSA. And for different customer segments, since all of these pay slightly different tariffs to the grid, for each of these customer segments in these regions, whether or not captive solar makes sense for them or not. The green blocks basically indicate that it's an attractive option for whether they want to install rooftop or whether they want to install car park or ground-mounted structures. The blue ones are basically that it's still attractive for ground-mounted structures, but not really for the other two options. And the red ones are the ones where, I mean, they're not really attractive or commercially attractive for the customers at this point in time. Few things I would like to highlight in relation to this table. Firstly, these are the tariffs as of date. Now, this is important to consider because See, each of the development structures effectively require 12 to 18 months or 10 to 18 months before any plant that is being planned for deployment, it comes active or it becomes operational. These are the tariffs as of date, and with the changes in tariff that we are seeing in the region, uh, customers will have to plan and pace themselves if they want as to when they want to kind of put these in place, because uh, the module prices have been decreases, they have been getting more efficient, and the tariff levels are increasing. So you really need to take into account that construction period as well when you're deciding whether or not you want to go for it. So it already makes sense for, say, commercial and industrial customers in Dubai, or say commercial customers in KSA. But even the ones that are, say, blue right now, I mean, they need to kind of start planning really and start exploring these alternate energy options, which can then potentially lower their electricity cost from the first day of their operations for them. Couple of disclaimers on this, just that, I mean, these are based on an OpEx model really. So for residential, while it showcases that yes, it's not a commercially attractive option, we see that many of them follow a capex model, wherein then the economics or the evaluation methodology is different, and they're kind of looking more at the time period by which they're able to recover their costs completely. So those are slight. I mean, with a capex model, the evaluation may be slightly different and may still be a consideration for residential owners. So this is kind of a summary on the really on the financial side. I will kind of pass on to Debbie for the legal related discussion.
Brilliant. Apan, well, thank you very much for insightful presentation. And we'll now move over to Debbie Barber, partner at DLA Piper, who will now give us an update on the legal and regulatory requirements for captive solar. So, Debbie, we will be passing it over to your screen shortly.
Thank you, Paul, and good afternoon, everybody. We're very excited also in relation to captive solar opportunities in the region. It's something which is only recently become topical, and it's an area that we think is going to continue to grow. It really is an exciting time, I think, for project finance practitioners to get involved. I'm going to touch very briefly, you'll be relieved to know, on the regulatory environment in both the UAE and Saudi, but then spend some time looking at the risk allocation and how captive solar transactions actually differ from those conventional projects. As most project finance practitioners in the region would know, power projects have been the bread and butter work for a lot of us over the past 10 years. And we're all quite used to those risks that those projects throw up, and there's fairly set ways as to how to allocate those risks. I think captive solar transactions are interesting because there isn't a set way to deal with those risks, certainly not yet. And it's a very interesting time looking at how those risks will be allocated. I thought it might be useful to take a look very briefly at some of the international examples that we've seen, because obviously when we look at these types of arrangements, there have been precedents in other parts of the world which are also useful to look at. In the US, it's probably the first region which saw significant corporate PPAs of the type that we're talking about being established. Google, perhaps unsurprisingly, was one of the front runners in terms of looking at these types of arrangements, but then quickly other household names followed, such as Microsoft and Apple, Walmart. Europe and the UK then very quickly followed as well. So in 2012, I think it was, Google did one of its first corporate PPA in Europe. And that was an interesting one, given the Nordic region shared electricity market. the transaction was actually structured so that Google bought the output of a wind farm in Sweden, but then consumed the same amount of power at its data center in Finland. And another interesting example, which I put on the slide, was in relation to Lloyds Bank, which actually entered into an arrangement taking renewable power from landfill gas plants. And again, that's interesting because sometimes I think we think that it's only innovative technological companies that enter into these types of arrangements. I think the fact that you've got institutions which traditionally have been seen as being quite conservative, such as large banking groups, entering into these arrangements show how widespread these arrangements have been becoming over the past few years. Australia followed more slowly, but has now, we're seeing a lot of activity in Australia, particularly given the renewable energy target of trying to see 20% of electricity generation being provided from renewable sources in the next few years. Anecdotally, I was back in Melbourne over the weekend, and every house on the street had solar panels. And the discussion amongst the neighbours was how cheap their power bills actually were. Asia, again, has come fairly late to the party, but we're seeing a lot of activity now in Asia and also Latin America. We're seeing quite a few of these arrangements in Latin America as well. Turning to the Middle East, I think it's fair to say that it's really only been the past 2 to 3 years that attention is being paid to these types of captive power arrangements, certainly in the GCC. There's a couple of reasons for that. First of all, most people would be aware that in the GCC, the electricity market is being dominated by government-backed energy companies. But perhaps the second reason, and one that Apan touched on just before, is that traditionally electricity prices have been comparatively low in this region, whether that's because of cheap fuel, but also because of subsidies. That the power prices have been heavily subsidized, and we're just starting to see those subsidies fall away. Obviously, to the extent there are low power, the cost of power is kept low, then there's hasn't been that much incentive for corporates to look at entering into what end up being fairly long-term arrangements to ensure that that they have access to a steady priced power supply. I think one of the other challenges, obviously, has been that often corporates in this region don't know what their business is going to look like in the next 10 years, and so to enter into long-term arrangements has been quite challenging. However, we have seen a big change over the past 2 to 3 years. Certainly, the GCC governments have been making a big push towards renewables. We've seen some very large renewable plants being tendered in the market, Sakaka in Saudi Arabia being one which has been talked about a lot recently. And that's caused a greater focus on renewables. And encouragingly, the regulatory environment has kept up with this move and sentiment. So Dubai was the first country in the GCC, first jurisdiction in the GCC to introduce regulations dealing with captive solar programs, and it's something which Dubai has been pushing. It's nicknamed the Shams Dubai Solar Program. Regulations were introduced at the end of 2014 and came into effect in 2015. And effectively, those regulations encourage building owners to install solar panels to generate electricity. The regulations only permit electricity and generation and consumption on the same site. But they also provide that surplus power can be exported to the grid, with the benefit of, for the customer, that their future power bills will be offset according to how much energy is exported to the grid. And this program has been met with quite a bit of success, and I think Yellow Door will be touching on this shortly. But encouraging also to see reports in the press a few months ago that DEWA has been actively promoting and consulting with developers about the initiative and ensuring that blocks to obtaining the relevant permits are being minimised. Abu Dhabi's followed. They published a guidance document in 2017 and have been introducing a similar mechanism to the net metering mechanism in Dubai. Last month at the Abu Dhabi Sustainability Conference, it was reported that there's actually 44 rooftop solar systems in Abu Dhabi, and that the total capacity of those systems has reached 6 megawatts, but that's expected to increase substantially this year and next year. And finally, Saudi has been active in this area as well. Regulations were introduced late last year. Currently, those regulations apply to installations of no more than 1 megawatt capacity, but again, there's a similar net metering regime to the one that Dubai has introduced. And encouragingly, ECRA, the regulatory authority, is looking at introducing regulations to cover installations of up to 5 megawatts. Turning now to risk allocation, as I mentioned before, we're all pretty used to seeing large utility projects being banked, certainly in the GCC. What's more interesting is looking at how some of those risks will be dealt with in captive solar projects and what will attract funders. So with conventional utility projects, really developers don't have to worry too much about the banking market because the banks are used to funding these types of projects. They like them. As I mentioned before, there's a largely settled risk allocation. The banks are generally lend fairly large amounts, get fairly large upfront fees. And because there are tried and true precedents, not a lot of time is involved explaining how the deal works to credit committee, etc. There's fairly tried and true documentation which is used for these types of projects. With captive solar projects, it's actually quite different. The deals tend to be a lot smaller, and there is a lack of precedent, certainly in the in this market. Obviously, in the UK, Europe, the US, precedents have been developed. But in this market, there is currently not too many precedents looking for the captive solar project market, which means that banks are looking at spending a proportionately larger amount of time trying to get these deals into a form which are bankable and which they can get comfortable with. I actually think it's a really exciting time, and I think we're going to see some innovative structures being developed. Certainly in the UK, one of the ways they've dealt with the relative small size of these deals is to look at portfolio deals. So banks come and finance a portfolio of maybe 20 deals with the ability to swap in and swap out projects as needed. And I think we'll see something similar here. Similarly, I was reading that India had commissioned IFC to produce a report about securitizing some of these types of projects. So I think we are going to see some innovative structures over the next few years in this market. Of course, one of the big differences with captive solar projects compared to a conventional utility project is the risk of the counterparty. So if you're looking at a traditional GCC power project, generally the off-taker will be a government entity or a government-backed entity. This differs from the captive solar project market, where generally you will have a corporate off-taker as the counterparty to the power purchase agreement, so that a bank will need to consider the strength of that corporate off-taker. They'll need to look at potentially ratings, credit ratings on that corporate off-taker. But there's also, I think, a concern amongst banks that the energy market is volatile. The renewables market is an area where there's been a lot of development over the past 10 years and presumably a lot of technical development in the next 10 years as well. And there's a concern, there must be a concern that if energy becomes substantially cheaper or there's a more efficient way of producing energy, that a corporate might be tempted to terminate a 10-year PPA if at year 6 they find a cheaper supply of energy. So again, something that banks will be concerned about. They want to see that the PPA is enforceable, and they want some guarantees that the corporate off-taker is actually incentivized to ensure that the PPA lasts for the duration that was intended to. Generally, with corporate PPAs, we're seeing terms of about 10 years or potentially less. one of the issues, of course, is that, as I mentioned before, corporates often don't know what their business is going to look like in the GCC in 10 years' time, and indeed how much power they might need. Sometimes they might not even know if they're going to be operating in the GCC in 10 years' time. So we have seen corporate PPAs internationally, probably a duration of these PPAs of about 10 years. Although, having said that, there's one deal that we were looking at last year in this region where there was an offtake arrangement which is contemplated for 25 years. And again, that was structured in a way so as to help make the deal more bankable. One risk which lawyers get excited about, and it's obviously a risk which is applicable to a project no matter where it happens in the world, is change in law risk. What happens with these relatively long projects if there's a change in law? I always think this is a risk which is particularly relevant for the GCC because we are seeing a lot of change in law, and I expect that we will see a lot of change in law in the foreseeable future. It was only this year that VAT was introduced. Certainly, there's been a lot of talk about VAT either being increased or corporate tax being introduced as well. So whatever projects we look at need to deal with this risk. Now, if you're looking at a conventional utility project where you've got a government off-taker, it's generally fairly accepted that the government is going to be in a better position than the private sector to take the risk of a change in law. But in a captive solar type arrangement where you've got two private counterparties, you've got a private sector developer and a private sector off-taker, it's not so clear who should take that risk. It doesn't fall naturally in any bucket. Traditionally, in some of the corporate PPAs that we've seen around the world, the parties often agree to sit down and discuss the effect of a change in law and try to agree a situation which would put the parties back into the same economic position that they would have been if that change in law hadn't occurred. I think the issue for that is in terms of financing, banks generally don't like a solution which involves let's sit down and talk about it when it happens. So I think that's going to be a really interesting risk to grapple with if these projects take off and are banked through commercial banking solutions. Electricity output's obviously an issue to be considered with each project. I think particularly with captive solar projects, you've got this tension where corporate off-takers will really only want to pay for the power that they need. There's with some of these.
Hi, Debbie. Sorry to interrupt.
Oh, sorry, am I talking too late?
No. Do you think well, 2 more minutes? Is that okay?
Yeah, can certainly wrap up.
Brilliant.
Yeah, no, definitely. I think the other thing to consider is with some of the more kind of bespoke issues which arise with captive solar projects, which don't happen on conventional greenfield power projects, such as underlying structural risk. If you're putting a solar panel on a roof, is that roof actually sufficiently robust to take the solar panel? What happens if the roof collapses? Who takes that liability? Similarly, if the equivalent of Kingdom Tower gets built the next block and causes shade over the solar panels, which have been installed on a roof, who takes that risk? Where does that risk lie? So I think a really interesting time. I think these issues are going to be discussed. I think we will start to see some standard positions emerge. But I think it's something which everybody's going to grapple with over the next few years.
Brilliant, Debbie. Well, thank you very much for that presentation, and sorry for interrupting. Obviously, everybody, if you attend the MENA New Energy Summit, you will have the opportunity to meet the speakers face to face and carry on an extended discussion. By all means, though, with the webinar platform, you can submit your Q&A, and they'll obviously do their best to come back to you. I presume all the speakers will also be happy for you to reach out to them by email later. But now, for our final speaker, Jeremy Crane, the CEO of Yellow Door. I'll be connecting to your screen now, Jeremy.
Hi, Paul. Hi, everyone. Thank you very much for attending today. Debbie, I think you did a great job in covering risk allocation, hit on many of the issues we've seen in the past. So thank you for that. So good afternoon. Just to just get my slides moving here. So I'm going to try to be succinct, as I know our hour is running a little bit short now. I'm going to cover quickly who Yellow Door is. I'm going to talk about some of the challenges and some of the solutions we see in the industry, but I'm going to focus on case studies. We've got 4 case studies to present today. So to begin with, Yellow Door is the market leader in the Middle East for solar leasing solutions. We provide solar leases. We also do energy savings contracts. Our goal is to help consumers reduce their energy consumption, reduce their utility bill, and reduce the greenhouse gas emissions that they face. What is a solar lease? Well, we've heard Arpan and we've heard Debbie both use different words for it today, so let me just really quickly define this. Arpan called it the OPEX model. Debbie talked about captive solar. When we say solar lease, we mean putting equipment out that is being used in a captive manner to produce solar or produce energy for a consumer, where they will pay through their OPEX budget rather than their CAPEX budget. So all of those words that have been used, I think, are accurate. And what does that mean for us? Well, when we are working with a customer, what do? We assess an opportunity, we review and sign a lease with the customer, we ensure that the system is executed properly, design, procure, build, and then we maintain it for the life of the system, finally handing it over to the consumer. This method of execution reduces a lot of hassles for the customer, requires them to essentially just sign a lease, which, as Debbie pointed out, maybe is not that simple, but it's one step. Pay the monthly bill like they would their utility, and then assume ownership at the end of the lease. We've worked with many customers throughout the Middle East. This is just a few of them, both on the energy efficiency side and the solar. We serviced primarily customers in the UAE and Jordan. So what are the challenges and what are the solutions? Well, the first one that has been covered a little bit, and I won't spend much time on, is policy and regulations. For a solar system to be implemented, there needs to be some sort of regulation. One type of regulation is net metering, such as the Shams Dubai that we've already heard about. Another type of regulation is wheeling. That's very popular in Jordan at the moment. And so those are ways of solving when you are working in an on-grid solution, on-grid scenario. As Arpan pointed out, off-grid is much simpler when it comes to regulations. Challenge number 2 is financing. Solar is very expensive, so a solution to financial investment would be to work with a third party in a solar lease scenario or a PPA, depending on what's allowed. One example, of course, is what Yellow Door does. We agree on a tariff with the consumer, and we give them a fixed tariff for a length of the lease, also reducing long-term operational risk. The third challenge that many people face are the technical challenges. How do I go about putting solar? Maybe I'm an expert in baking bread. Well, you can hire solar experts with relevant experience. In a solar leasing solution, of course, you're passing on all of that risk to the solar leasing company. And then the fourth challenge would be business focus. Again, I'm a bed break. I bake bread. My team are experts in that. How do I ensure that solar is going to be built properly when I don't know anything about it? I don't want to divert my resources. So I entrust a third party. And that's, of course, something that, that Yellow Door can do. Now, I'm going to run through 4 case examples that highlight each one of these risks. The first one on regulations is a project that's currently under construction for 2 of our customers in Jordan, the Specialty Hospital and the Istiqlal Mall. This is a 4 megawatt wheeling plant. This means that we built outside of the city of Amman a 4 megawatt ground mount plant where it's grid connected, supplies into the grid, and provides these customers with the benefit for the solar that from the solar energy. This is a relatively cost-effective way for the consumer to receive a lot more energy than they would be able to if they were simply doing it on the rooftop. Most people know that commercial buildings have many things on the rooftop. They're very busy. There's little room for solar. So wheeling is a great solution for that. And we hope that many countries in the region do choose to adopt that in the future. The second example is to deal with the financial side. And here we're talking about something in our backyard in Dubai, the Unilever plant. Unilever is building a brand new facility. They were looking to limit their CapEx investments. And so working with the local EPC for this project, Value Addition, we presented a solar lease, and it was adopted and executed. And they now have 1 megawatt of solar operating. They didn't pay a penny for up front. They pay for simply on a monthly basis the power that's generated. They also have obviously long-term visibility into what the cost of power is, mitigating any risk there. The third example is on the technical case, and this is a project. Picture here is under construction, but I can tell you it's fully operational now. This was built by Elsa Solar, and it's in this case AMI Logistics was interested in solar. They recognized they didn't have the expertise in-house to procure and fit out their building with solar. So they opted for the lease to avoid that risk and the technical risk, where Yellow Door takes on that risk for the duration of the contract. And then the final example is one that actually has just started in the construction. Panels, I believe, are on site now. And this is Al Nabuda, one of our larger installations, just over 6 megawatts. This particular customer was very interested in solar, but again, their business focus was on operating their car repair facility here, car servicing and painting factory, and not wanting to divert their resources from that, they opted for a solar lease. And I believe this will be an amazing installation in Dubai in DIP when it's complete. So that said, just wrapping up in summary, we talked about the solar power, the benefits of solar power in the MENA region, which I believe are cost savings for the customer, the challenges and solutions that a customer will face and how they can avoid them, and finally the solar lease. What is the benefit of that structure for a customer looking to save money and go green?
Brilliant, Jerry. Well, thank you very much for that presentation. The last one of our 3 speakers. I suppose we only have about 5 minutes for Q&A. So, Apan, Debbie, are you there? Are you tuned in as well to deal with some discussions? Were there any key themes that you would like to mention as we have a final send-off to everybody listening in? I'll start with Apan for you to take the lead.
Sure, Paul. We're here. So I think I'll just kind of respond to one of the at least one of the questions that kind of came in, which we haven't kind of responded in text. So there's a question on whether we see financing being a big challenge to the project, and does the size of system effectively affect the likability of an investment in this sector? So see, fundraising for captive projects is definitely different if you kind of compare it with standard IPP structures. But we have seen that there's a lot of interest from the local lenders, at least the ones who are able to then take the credit risk of the off-takers, because that kind of becomes an important parameter when they are kind of looking at these projects. And that obviously then impacts the pricing, the tenor, and the other commercial terms that they are able to offer to the developer. Now, in context with that, based on the developer, they are also seeking, or we have seen them seek, some sort of construction period support or comfort that they can rely on during the construction period. So, I mean, net in net, even considering project sizes of say 50, even 100 megawatts, I mean, there is as long as there is local market depth, they are able to get that funding. For extremely small ones, actually, it becomes even more challenging for the very small ones. If you start going south below 50 megawatts or 20 megawatts, I mean, that's where it really starts becoming difficult to raise financing independently.
Brilliant. Thank you very much, Arpan. And Debbie, I guess I don't suppose, having seen some of the questions come in, or some of the questions directed at yourself, if you've got any final comments which you'd like to add to the audience?
I think, just to repeat what Arpan was saying, I think the really interesting thing about these types of projects is how to make them bankable. And as Arpan said, local banks are interested. We've actually received queries also from international banks that have had quite a bit of success financing projects in Europe and UK, and they're also interested in the market. But the challenge, I think, will be to ensure that the projects are of a sufficient size. So whether that's by looking at portfolio deals or looking at a stream of standardized PPAs. But I think I think there will be financing solutions. I think also we're going to see alternative financing providers as well being interested in this, funds and that kind of thing as well. I think there's a big place for local funds to play in financing these types of projects as well.
Thank you very much. And I guess, Jeremy, I suppose a few questions came through at the end as you were the last speaker, but were there any common themes or any particular points that you'd like to address? Obviously, I know the speakers are very responsive by email, so if your question wasn't answered, hopefully you'll be able to have your question answered later on by email. But Jeremy, on a final point, do you have any comments?
Well, Paul, I could just run through a couple of the questions that came in, which I think were excellent. There was one question from about VAT and how that's going to affect leasing in the UAE. The law on regulations for VAT around leasing are quite clear today. For any leased equipment, the beneficiary of that has to pay 100% of the VAT on the value of that system on day one, and so there's no way around that. Another question which came in was around cross-border leasing. In the UAE, that's not possible to be a leaser of equipment. You have to be registered with an onshore company, an LLC, in the UAE. There's a couple questions about sort of servicing, operation and maintenance, cleanliness. Obviously, that's an issue in our dusty environment here, and certainly something that I think everybody needs to consider when it comes to their operational budget, that they can do very regular cleaning, and so that's something that is critical to the success of solar here in Dubai.
Brilliant. Well, Jeremy, thank you very much for that. And Apan, Debbie, likewise, thank you for your comments and for your participation in this webinar. I'm afraid we do not have any more time for any more questions. So if you would like to ask more questions, I would advise you to attend the MENA New Energy Summit in April on the 24th and 25th in Dubai. There you'll be able to meet our speakers face to face. As I've said, captive solar is going to play a huge role at the event. We have, in fact, 3 panels on captive solar or similar versions of captive solar. I think we have a corporate PPA panel, we'll have a distributed generation panel, and then we'll have a broader captive solar panel. So plenty of speakers and plenty of opportunities to take the discussions further. But as I've said, I'm sure if your question wasn't answered, the speakers will get to you by email. But again, thank you very much for listening, and I will hopefully see you in Dubai in April. Have a nice day, everyone.
Thank you, Paul. And thank
Thanks,
you,
Paul.
everyone.